As of April 30th, premarket trading activity reflects continued upward momentum, with the stock advancing approximately 3% to 4% ahead of the open. This move builds on a recovery phase that began following the sharp decline observed on March 20th, a period during which the market repriced the stock amid uncertainty and negative sentiment. At that time, the expectation was clearly defined, a short-term rebound toward the $30 level within a matter of weeks. That outlook has largely played out as anticipated, with the stock recovering into the $26 to $27 range and now steadily approaching the final leg of that initial target. The progression from the March lows to current levels reinforces the idea that the prior decline was not structurally driven, but rather a temporary dislocation within a broader upward trend. From a near-term market perspective, the remaining upside toward $30 is relatively limited in absolute terms, but still meaningful for short-term participants. With only a few dollars separating the current price from that level, the continuation of this upward movement appears achievable under stable market conditions. For traders focused on short-duration opportunities, the setup remains favorable, particularly as momentum continues to rebuild and sentiment gradually improves. The fact that this recovery has unfolded within the expected timeframe further strengthens confidence in the underlying price behavior and market structure, suggesting that the stock is responding predictably to both technical and fundamental drivers. Valuation remains an important component of the broader investment case. Despite the recent recovery, the company continues to trade at a market capitalization of approximately $15 billion, with a price-to-earnings ratio near 19. These metrics indicate that the stock is not yet fully reflecting its forward growth potential, particularly when considered in the context of its revenue trajectory and sector positioning. In relative terms, this level of valuation leaves room for expansion, especially if the company continues to execute on its growth strategy and deliver improving financial results. The current pricing, therefore, still offers a degree of asymmetry, where the upside potential outweighs the downside risk under a stable operating environment. Looking beyond the immediate recovery phase, the medium to long-term outlook is defined by a continuation of growth trends that are already visible in the company's financial performance. The expectation for the stock to reach $40 in the coming periods is grounded in this expansion narrative, with further upside toward $50 over a multi-year horizon if key assumptions hold. From current levels, this represents the potential for a doubling in value, particularly if the company maintains its growth trajectory and successfully scales its operations. The relationship between revenue growth, profitability, and valuation expansion becomes central here, as each component reinforces the other in a compounding manner. Revenue projections play a critical role in this thesis. The company is expected to grow its top line from approximately $21 billion to $40 billion, effectively doubling its revenue base over time. This level of expansion, particularly when sustained at a growth rate exceeding 40%, signals strong demand and effective execution within its core markets. However, revenue growth alone is not sufficient. The ability to maintain or improve profit margins is equally important. If the company can translate this revenue growth into higher earnings, the impact on valuation could be substantial. For example, an increase in net income from around $1 billion to $2 billion would represent a significant step change in profitability, supporting a materially higher market capitalization. Even achieving a midpoint scenario, such as $1.5 billion in earnings, would strengthen the financial profile and provide a solid foundation for continued stock appreciation. At the same time, it is important to acknowledge the factors that have contributed to investor caution. Reports indicating that certain managers were involved in the sale of restricted chips to China introduced a layer of uncertainty, particularly given the regulatory and geopolitical sensitivities surrounding such activities. While those individuals have since resigned, the situation has raised questions around internal controls and compliance. As of now, no significant penalties have been imposed, and there is no clear indication that such outcomes are imminent. However, the presence of these concerns, combined with the company's past issues related to filing delays, has influenced market perception and contributed to periods of volatility. These elements, while not necessarily altering the long-term fundamentals, do affect short-term sentiment and investor confidence. Despite these concerns, the underlying business momentum remains intact. The company continues to demonstrate strong revenue growth, and if this trend persists, it is reasonable to expect that the stock price will eventually align with the fundamentals. The key variable remains profitability, as sustained improvements in earnings will serve as a catalyst for valuation expansion. Achieving earnings in the range of $1.5 billion to $2 billion would not only validate the growth narrative, but also provide the financial strength needed to justify a higher market cap, potentially approaching $40 billion over time. In the broader industry context, demand for artificial intelligence infrastructure remains a central driver. The company's positioning within this space provides exposure to one of the most significant secular growth trends in the market. If demand for AI-related hardware and systems continues over an extended period, the upside potential could extend well beyond current conservative estimates. Under such conditions, there is a pathway for the stock to revisit significantly higher levels, potentially approaching $100. However, a disciplined and conservative framework would focus on more achievable milestones, such as the $40 to $50 range, which are supported by current growth assumptions and do not rely on overly optimistic scenarios. The stock has already delivered a substantial recovery from its March lows and is now approaching its initial short-term target near $30. While near-term opportunities may still exist for incremental gains, the broader investment case is driven by sustained revenue growth, improving profitability, and continued demand within the AI sector. Valuation remains reasonable relative to these growth prospects, and although certain risks and uncertainties persist, they have not materially altered the long-term trajectory. Assuming the company continues to execute effectively, the potential for meaningful upside over a multi-year horizon remains firmly in place.